Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So this is the week we got Warren Buffett's last annual Thanksgiving letter. Greg Abel is set to take over as Berkshire Hathaway's CEO at the end of this year. I will no longer be writing Berkshire's annual report or talking endlessly at the annual meeting, Mr. Buffett writes. As the British would say, I'm going quiet. Sort of. His letter is really a memoir, extolling the virtues of a Midwestern upbringing and enjoying more than a little good luck. He finishes with this: greatness does not come about through accumulating great amounts of money, great amounts of publicity, or great power in government. When you help someone in any of 1,000 ways, you help the world. Kindness is costless, but also priceless. Words from the wise. This week, our three things are: 1. Holiday spending. Will the wealthiest among us offset the headwinds? 2. Surging earnings. It's more than just mega tech. And 3. Senior loan officer color. Post Tricolor and First Brands, the Fed's out with its latest survey. All right, let's dig a bit deeper. Holiday spending. So a talking head on Bloomberg this week described the economy as a delta economy, something we're all familiar with, Group 1, or those in the front of the plane, and everyone else. We have long described it as our two economies, wealthy households and larger businesses, flourishing for the most part on one side, and less wealthy households and smaller businesses challenged on the other. We are heading into the holidays with essentially the most depressed consumer sentiment recorded in the University of Michigan's Consumer Sentiment Survey's 77-year history. As Elon Musk would say, let that sink in. We're heading into the holidays with inflation creeping higher. We're heading into the holidays with those expecting unemployment to rise at a level seen only at the depths of the GFC. And we are heading into the holidays with inflation expectations in danger of becoming unmoored. So, safe to say, confidence is low. All right, back to the spending outlook. The National Retail Federation predicts spending to grow 3.7% to 4.2% year on year, right on top of the longer run average. Consumers, however, are budgeting 1.3% lower than a year ago. Somehow every year, Santa Claus always comes, says Matthew Shea, CEO of the group. KPMG expects spending to increase 4.6% over a year ago, led by households with more than $200,000 in income, expected to be up 9%. Households with less than $50,000 in income are expected to cut spending by 2%. Its survey reveals that 79% believe tariffs push prices higher, while 80% cite inflation as their top concern. Deloitte pegs the year-over-year growth at 2.9 to 3.4%, on the back of a 3.1 to 5.4% growth in disposable personal income. The firm comments, "We expect this holiday season to demonstrate the resiliency of consumers as they continue to face economic uncertainty." The firm highlights value-oriented retailers as well-positioned in this environment, something consistent with what we heard from Walmart in its quarter ended July. Walmart expects a strong holiday season. Visa is calling for a 4.6% year-over-year increase, despite a, quote, trifecta of weaker job growth, elevated inflation, and extreme economic uncertainty, unquote. And finally, PwC's holiday outlook is more downbeat than the others, calling for consumers to cut spending by 5% from a year ago. It should be noted that this survey was conducted back in June. In any event, spending is likely to remain relatively buoyant, supported by our view that the wealthy will carry the day once again in sufficient magnitude to offset weaker trends among the less wealthy. It's worth remembering that the low unemployment rate sets a floor as to just how much the less wealthy will fall. All right, on to our second thing, surging profits. We talked last week about uncertainty, how it's actually reduced over the past 6 months on the trade policy front, on the interest rate front, and on the economic growth front. That improved backdrop, allowing risk takers, including business managers, consumers, and investors, to take risk, now looks like it has transmitted into a continuation of strong earnings growth. That's good news for credit investors, as we know that the performance in the corporate sector underpins every asset class in credit. Our friends over at Deutsche Bank note that the earnings beats in the US, Europe, and Japan thus far are near the top of their historic ranges, and global earnings growth is 11.3%, the highest in over 3 years. In the US, with 92% of the S&P reporting, 75% show year-over-year earnings growth, and 82% beat the consensus estimate. The average earnings growth rate is 15%, double what was forecast heading into earnings season. Firms in the large cap index will have reported double-digit earnings growth in 5 of the past 6 quarters. Earnings breadth is improving. Excluding the Mag 7, the rest of the S&P grew earnings by 9.3% in the latest quarter, compared to 4.4% in Q2. Sales growth is currently 8.3%, the highest since the third quarter of 2022. Some 84% of firms grew sales year over year, while a high 67% beat the market forecast. Operating margin was better than expected in 52% of reporters. 8 of the 11 S&P sectors are on track to show positive year-over-year earnings growth, led by information technology, financials, utilities, and materials, all reporting better than 20% growth. Only one sector, communication services, reported a downdraft of 5% or more, and that was down 7.1%. Every sector reported sales growth. There's that reduced uncertainty, led by double-digit growers in infotech, healthcare, and communication services. Looking ahead, Q4 earnings are forecast to grow 7.4%, reflecting greater impact from tariffs and a more sobered consumer. But if history is our guide, a more normal beat pushes that up toward double-digit growth, and that is more than good enough for credit. All right, on to our third thing, Senior Loan Officer Color. The Fed released its latest Senior Loan Officer Opinion Survey on bank lending practices, otherwise known as the SLOOS, this week. The survey was sent out September 22nd to 65 domestic banks and 16 U.S. operations of foreign banks, with responses due October 3rd. It is meant to reflect changes in loan underwriting standards taking place during Q3. Interestingly, problems at Tricolor and First Brands began surfacing prior to the survey's response window. So banks reported modest tightening of lending standards on commercial and industrial loans to firms of all sizes, and little change on loans on commercial real estate and to consumers. After a tumultuous chop in lending standards ever since the pandemic, the survey data suggests that we are now post-pandemic and post-tariff scare, as lenders face a fairly constructive, if far from robust, economic environment. Among banks that reported tighter standards for C&I loans, reasons cited include a less favorable or more uncertain economic outlook, increased concerns about the effects of legislative changes, supervisory actions, or changes in accounting standards, the worsening of industry-specific problems, and a reduced tolerance for risk as important reasons for doing so. Among banks that reported easier standards in terms for C&I loans, more aggressive competition from other banks or non-bank lenders was cited as an important reason for doing so. The survey always incorporates a few timely special questions. This go-around, bankers were asked about lending to firms with exposure to trade and on changes in demand for C&I and consumer credit card loans. Not surprisingly, bankers were less likely to approve loans to firms with high trade exposures. Regarding demand for C&I loans, banks seeing increased demand cited borrower needs to build inventories ahead of tariffs and improved pricing. Those banks that reported weakening demand cited the attractiveness of non-bank credit sources. On the card side, no surprise that banks were more likely to approve cards to prime and superprime borrowers and less likely to approve near and subprime borrowers. So bankers are telling us that lending conditions are generally constructive overall, but two economies are plainly evident, as is the perceived drag of trade policy developments. And bankers acknowledge the competitive threat of commercial lending non-banks. As we pointed out several times recently, the emergence of credit cockroaches, using Jamie Dimon's label, means that every lender is going to go back in and scrub their loan portfolios for weakness, as well as tighten underwriting standards on new loans to vulnerable borrower categories on both the commercial and the consumer side of the ledger. While this is good lending hygiene at this part of the credit cycle, we also point out that there is a cost to this, namely a slowdown in growth. So there you have it. 3 things in credit. 1, holiday spending. Don't underestimate the power of the wealthy. 2, surging earnings. U.S. exceptionalism is evident once again. And 3, senior loan officer color. Reduce uncertainty as a plus, but wait for the next survey when more of the cockroaches have come out. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. And finally, for those interested in what's going on with banks, you'll want to attend our KBRA Bank Symposium one day, November 19th, at the Willard Hotel in Washington, D.C. Among our speakers and panels will be presentations by Jonathan Gould, head of the OCC, the agency that oversees all nationally chartered banks, as well as political pundit Jim Vandehei, co-founder and CEO of Axios, who just published a worrisome note on the impact of AI. You'll want to join us in Washington. To learn more or register, visit kbra.com/events. We'll see you next week.